A couple quick announcements before we get started. A reminder, basically reminders. So next week there is the Fall Career Fair from 9:30 to 12:30. So definitely recommend, next Tuesday. Definitely recommend you take some time to check that out. This could be a great opportunity to meet people. And going on right now until 3 o'clock is the Risk Management and Insurance Career Fair. So if that's something that you have any potential interest in, definitely recommend checking that out. Right, like I mentioned last class, if you need to miss class for some career networking thing, totally understand. All lectures are recorded and posted on D2L. Gotta focus on taking care of yourself and getting a good start to your career. So. Right, the career fair next week ends before class starts, but if you need some extra time to go check out RMI, right, the average attention span is somewhere around 30 to 40 minutes. So I know everyone starts checking out after about 40 minutes, and especially with stuff that gets as complicated as finance does. So yeah, if you need to stretch your legs, go stretch your legs to something that can help out your career. All right, any questions before we get started?
Yeah. I missed what you were saying. What was that going on out there?
Risk Management and Insurance Career Fair. Yeah, it's just on the other side of the building, second and third floor. I was talking with some people there. Right there, some good options, work from home options. I know that's increasingly valuable. This is one of those fields where very often you can work remotely for a lot of things that you're going to be working on. So, yeah. Any other questions? All right. All right, so we're going to talk a little bit about how stock markets work and then talk about how we can go about valuing stocks, which basically it's a DCF problem, right? So it's, again, similar to when we were dealing with bonds. We're going to be using time value. We're going to be using cash flow tables. There's just some nomenclature that's particular to the stock market. All right, so when we talk about stock, what are we referring to? Broadly, it just means ownership. Right? When we're talking about stock or equity, really what we're referring to is ownership in a company. In particular, residual claimant to a company's cash flows. Right? As the owner of a firm, you have residual claimant to the company's cash flows. All other stakeholders have to be paid before any value is being paid out to the equity holders or the owners. Right? And theoretically, that's why there's focus on maximizing shareholder value, because they're the last claimant to a company's cash flow. Right? In practice, there are unfortunate incentives in modern corporate compensation structures. But that's unfortunately the difference between theory and practice, right? Human emotions can cause some problems. In general, we have private and public sort of companies. Private companies are the most common form, right? In terms of the number of private companies, there are many locally owned companies that people run. So that's the most prevalent. And then there are public companies, right? Something like Amazon, and those have the most market value. In other words, like the largest aggregate amount of revenues, market share, market value of equity, stuff like that. All right, so when you hear someone talking about stocks or equity, broadly, it means, question.
So do you think that most companies, when they go from private equity to public, it's because they want to maximize their value in the market most of the times?
There's a few motivations for it. So on the one hand, it's one of the largest sources of capital that a company is going to receive. So in research I've done, basically we find that there's often a period where companies need a lot of external capital, and they use that to fund like their biggest projects, and then that's what they then go on to generate consistent cash flows from.
So they just trying to get more money to make the company bigger, and then they go public.
Right. So public equity markets are some of the largest investments that companies are going to receive. That's one aspect of it. Another aspect is owners trying to just basically have an exit strategy. Right? If you own a large private company, finding someone else to take over can get increasingly difficult. So being able to sell your shares and kind of move on and let the company continue going without you being involved is really important for a lot of people. That's one of the challenges in privately owned companies. Right? If you're running a company for yourself and you developed a really good business, they can be difficult to have that business continue when you retire, right? So, right, maybe you intend it to be a family-run company. I've got a family member that's done that, and a lot of family members aren't interested in necessarily taking it over, right? So he's got a problem with, okay, who's going to take over the company when he's ready to retire? So going public basically eliminates that issue because there's going to be a chain of people that can come up and help take over, right? So raising external capital, having an exit strategy, it's also in itself a great publicity. Like you start getting free marketing on your company from that point forward. Right when I've learned about some companies and their products and services just because they go public that I didn't know they existed before then. So once a company goes public, then they become part of just popular business media talk, and that can help raise awareness for what they're producing.
So whenever they go public, whoever has or owns the most stocks of that company, is that person the one in charge of selecting the board of directors? That way the company keep going? Or
Theoretically, they're not supposed to be. The point of a board of directors is to look out for shareholders' general interests. Over time, there's been a problem, though, where public companies tend to have board of directors that are basically do whatever the CEO wants. And so that sort of incentive structure basically undermines a company's ability to really pay attention to shareholders and generating
the
value.
board of directors are above the CEO?
Technically, yes. Yeah. So, right, the theoretical structure are, I think we spoke about this on the first class. Right, so theoretically, the structure is shareholders have the final say, they vote on things. The board of directors are supposed to look out for shareholders' interests in terms of setting corporate policy in the large. And the CEO is in charge of long-run direction and performance of the company, the face of the company. And so this is theoretically how the structure of a company is. In practice, though, very often CEOs will be telling the board what to do. It's board capture, basically. Being on a board of directors of a public company is a very nice job. You get a six-figure salary for meeting several times a year. It's just a fantastic job to have.
And if I recall, I think you mentioned in the last class that the board of directors are the one who assign the CEO, right?
They can nominate the CEO, not necessarily. Right, so it kind of depends on the timeline of when the board gets in. Right, so for example, a good example would be something like Meta. Right, Mark Zuckerberg is the founding executive of the company. He's still running the company. Meta also has dual class voting shares that gives Mark Zuckerberg an outsized vote in what shareholders vote on. So in situations like that, where he's nominating people to the board of directors who are supposed to be basically the watch guard on the executives at a company, it gets basically a reverse incentive where now the CEO has a disproportionate say in what the board is choosing to do. So theoretically, that's the chain of command. In reality, it's different than that, and there's been a lot of CEO capture for board performance. But in general, companies that have board of directors that are independent from the CEO, basically just outsiders that are just here on the board and looking out for the company, they tend to perform better than insider boards where basically the CEO and other insiders at a company are stacked on the board.
Okay.
Yeah, so theoretical structure, in actuality, it's a little bit more complicated. All right, so in general, when we're talking about equity, we're referring to ownership. It can also refer to the dollar value of that ownership or the total number of shares outstanding. But in general, all we're talking about is ownership residual claimants to a company's cash flow. All right, so some components of stock. We have common stock. So when we're talking about stock or equity, this is really explicitly what I'm generally referring to. All right, so unless I say otherwise, when I say stock, I'm referring to common stock, and that's the lowest claimant to a company's cash flow and equity in a company. So they don't have priority to dividends or payouts in bankruptcy, meaning they're the very last stakeholder to have any claim in a company's cash flow. Literally the last stakeholder in line for a company's cash. So typically shareholders are going to elect directors. Very often these directors can be nominated or suggested by CEOs, and unfortunately it tends to go that whoever the executives nominate tend to get broad support, right? So it basically ruins that whole independent board structure. As a shareholder, you have the right to vote on important matters in a firm. And there's two different types of votes that companies can have. There's going to be cumulative voting. So this is basically where, right, if say a company has 10 shares and you own 2 of them, you can put 2 of those share votes on one person that you're nominating to the board. So basically, you can stack your shares to vote and support one particular person that you want to have a say on the board of directors. And then there's also just straight voting where everyone is going to vote yes or no on each person that's elected to a board seat.
Do you have to have like a specific amount of stock to be able to vote?
Nope.
No.
As soon as you own a share, you have a right to vote. I don't remember how it works with fractional shares, actually, now that I'm thinking about it. Fractional shares are something that have started to be issued in companies where basically you own like a quarter of a share. So I don't know how voting would work in a situation like that. But once you own an entire share, you have the right to vote on shareholder matters, right? So once you open up a brokerage account and start investing with public companies, you'll get email notices on quarterly or annual meetings when they're voting on important things. And they'll send you all the information for what's being voted on. And then you just basically follow the links and vote yes or no on.
So as long as I have like one stock or one share of a company, I can vote.
Yeah. As soon as you own a share, that gives you a right to vote on company matters. Any other questions?
So I own 51% of these shares, and I pretty much have the last word. Or
You don't even need that much. You need 50% plus 1 share. Yeah. 50% plus 1. That gets you a majority vote.
so pretty much it doesn't matter where everybody votes. Pretty much I get the last word.
Yeah. If you have 50% plus 1, yeah, exactly. And there are some equity structures that give different voting rights. I don't remember if I have a slide on that now, but basically something like Meta, there's dual classes of common equity. Very, very often they'll have the same claim to the company's cash flow, proportional claim to the company's cash flow, but one will have a higher weight in voting for matters. So, yeah. All right, and there's also the possibility for something like proxy voting. So an authority, voting authority is passed from one shareholder to another. This is very often when you just hold on to passive ETF funds, right? So for example, if you hold on to like the Vanguard S&P 500 index, it's BOO ticker, right? You basically passively own a fraction of all companies listed in the S&P 500. So in a case like that, very often the ETF operator is going to typically vote on behalf of shareholders. Yeah. And some companies do have different classes of stock. Berkshire Hathaway is another example. They have dual voting rights, but they have the same cash flow claim, right? Berkshire Hathaway is notorious for the cost of its stock. So, all right. Take a guess, just random guess, what you think a high stock price is.
Honestly.
60,000? I mean, yeah, 60,000 a share. That sounds really high.
700 to 1,000.
Yeah. Berkshire A is a little under $700,000 a share. Very, very expensive. It's been around since, I believe, the early 70s. And this is its Class A share. When we look at B, it's still relatively high, but a fraction of the price at $500 per share. Right? So the Class A shares have never been split. They've never done anything to manage the supply of the number of securities outstanding, just letting it purely appreciate over time. They issued the B class, I think, sometime in the late 90s, just to have a more affordable option for people to have say. But again, has, I believe, a lower voting right relative to the A shares. Right? So the value of votes matters, right? As you can see in the difference of those two share prices, almost $700,000 per share, right? That's a home right? A single share in that company's A-class stock is basically a home. And that's what that voting right can be worth in some companies. So these different classes of stock have become a little bit more popular recently, especially with the original founding entrepreneurs in a company if they're still having ongoing management in the firm, right? So something like Meta. So it's possible that we'll see more of these sorts of class shares outstanding in the future. We'll see. All right, so in addition to voting, we have claim to come. Oh, yes.
So what is the difference between issue and outstanding shares? Isn't issue like what a stakeholder have in their possession?
So typically issue means creating for the first time or opening up to markets for the first time. And what was the second phrase?
Outstanding.
Outstanding. And outstanding are shares that have been issued to the market previously. Right? So it's the difference between adding a share to a market and a share already existing and just being traded in the market. And we'll get to that actually in a couple of slides. There's primary markets where companies go for their initial public offering, which is the initial share issuance. And then there's the secondary markets like the New York Stock Exchange where individual investors will be trading securities after they've been issued. Right? So unlike bonds where they have a maturity, they're going to be fully paid off in a specific time. Shares don't have that expiry, right? Common equity is issued with the intent of existing indefinitely. So people can just buy and sell shares from one another over time. There's no end period to the company unless the company just goes under. Companies can exist indefinitely. Actually, insurance companies are some of the oldest companies in the world. A lot of some of the oldest companies in the world are from the insurance world because those are very long-term looking companies that focus on long-run performance. All right, so some other things that shareholders have a right to, a proportional share in all dividends, right? So if a company pays a dividend, it's going to be equally split across all shares outstanding, right? So again, using that 10 share example, if there's going to be a $10 dividend paid out across all shareholders, each shareholder will get $1. 10 shares, $10 to split, $1 per share. They have a right to share in any assets after liquidation, proportionally, again, similar to dividends. Right, companies still have value when they're defunct, right? So Enron is a good example. That company went under, I believe it was around 2010. Equity holders of that company at that time, their shares were worth very, very little relative to the market peak. And it took about a decade to sell off all of their assets and pay off debtors or pay off creditors and get any value left over for shareholders. But there is still at least some value in a company after they disappear. And they also have a right to vote on any other important matters like mergers and acquisitions. All right, so I mentioned last time that the bond market in aggregate is larger than the stock market, right? The U.S. Treasury market is about 2/3 of the entire U.S. stock market, and that's just one bond issuer. And companies issue bonds much more frequently than they issue stock. So why does the stock market get so much attention? There's kind of a few reasons for that. The main reason, though, is basically they can be seen as a pulse on the economy. Financial markets can react very fast to information. Right, where it can take months for us to have established that there was a recession in a given time, we can see markets crash and rebound very quickly. So financial markets react very fast to information. And broadly, that reflects changes in economic conditions. Right, there's a lot of research that looks at how markets respond to information as basically a signal for whether or not that information has positive or negative implications for company performance. There's also a lot of money tied up in the stock market. Right, the default 401k investment is basically a mixed investment between stocks and bonds that passively changes over time. But a lot of people have significant sums of money tied up in the stock market, so there's a lot of attention paid there. And also, the stock market is a lot more active and transparent than the market. Right, so we have decentralized exchanges that people buy and sell their securities on. So we have a lot of information that's going to be tied to stock prices because stock markets are typically more active and more transparent, right? The bond market is over the counter, so buys and sells aren't going to an independent exchange for people to see. So when we're looking at a market, there are some things that are common across all markets. I believe we already talked about this, I think, in the second or third class. Just going over it again. So we can have buyers. So buying a stock usually means you're long on that stock or long on the asset. Generally, it means that you think the price is going to go up over time. Then there are sellers. If you're selling an asset, that means you're short on the asset or short on the stock. And usually it means you think that the price is going to go down. It's also possible to sell a stock short, meaning you typically would borrow the stock and sell it at an agreed upon price, thinking that the price is going to decline and you'd make profit from that price decline. One bit of warning that a lot of people don't think about when they start shorting something, right? There is no upper boundary for the price of an asset, right? In the stock market at least, right? The value of things can continue increasing. Whereas there is a limit for how much you can gain when you short a stock because the most a price can decline to is zero, right? So in other words, there's unbounded upward potential, which means there's unbounded loss when you short a stock. So I very strongly urge you to consider your options if you're thinking about selling short a stock because there is unbounded risk potential, unbounded loss potential when you short a stock. Then we also have market facilitators, right? We have brokers who arrange transactions between investors. Typically, money is just going to be between the buyer and seller, and the broker just arranges. And then dealers who buy and sell securities on their own accounts, right? So someone that's working on behalf of some investment fund. Right? And this is the basic structure for generally any market. In particular, for financial markets, we have the facilitators and the buyers and sellers. Right, so we also have what's called the primary market. So this is where companies go to raise money for the first time through initial public offerings, right? This is where companies are actually getting money out of the stock market. And then we have secondary markets where investors are going to be buying and selling securities typically, right? So like the New York Stock Exchange, NASDAQ are the two most common ones in the US. All right, so this is where we're going to be buying securities. So companies raise money in the primary markets when they issue their IPO. After that, when the company's price is increasing, that's not money that's going to companies, that's money that's going to shareholders. Right? So after IPO, once the securities start trading on the secondary markets, that's now where investors can get a return on an investment over time. So New York Stock Exchange, this is one of the largest and most well-known exchanges in the world. The New York Stock Exchange, NYSE, it was founded late 18th century. Usually it's going to be listing larger and profitable companies, though with the competition from NASDAQ, they've been kind of changing their listing requirements for companies listing on the New York Stock Exchange. Any member is someone that owns a trading license. And then there are designated market makers, which are basically dealers for particular stocks, basically help facilitating trades in the market, right? So they'll help make sure that order flows go through as efficiently as possible so that buyers and sellers are able to receive their money on a trade quickly. Then there are floor brokers, so basically just executing trades on behalf of customers. So the market makers are basically just making sure that if there's any lag with floor brokers helping execute a trade, they can come in and help facilitate the trades. And then additional liquidity providers, so investment companies that are actively managing their portfolios and are trying to make a profit or loss from, or not trying to make a loss, they're trying to make a profit on changes in a company's stock price going up or down. All right, so this is the growth in the New York Stock Exchange from 1992. Right, so we see that the price of the index increased from, I think it was about $300 up to just under $20,000 as of this morning. Right, so a total growth of 722% over the last 3 decades now. And there's also the NASDAQ. I'm never going to remember what that acronym stands for. National Association of Security Dealers Automated Quotations. This was founded much later, and I don't remember the market cap now. That second bullet point might be slightly outdated. It's coming close to the New York Stock Exchange if it hasn't passed already. But usually it lists smaller and riskier companies, so something like tech stocks, and tech stocks have a very high market valuation right now. This exchange became much more prominent around the tech bubble, right? In the late 90s, the tech market was valued very, very highly, and eventually it burst, and there was a lot of tumult around that. But if we look at the growth of this index over the same time, it grew it grew over 3,000% over that same time period. Right? And this is an important thing to keep in mind with asset markets and exponential growth. There are periods where we see crashes. Right after the dot-com bubble, it took around 15 years for the NASDAQ to recoup to pre-bubble price levels, right? And there's still other drops that we see around the financial crisis. It declined. So financial markets can drop. The Japanese index, the Nikkei index, that had been stagnant for decades, and it took a long time for it to recoup and start growing over time. But in general, we do see that asset markets increase exponentially over time, which we've seen in our time value problems that we've worked on in class, right? Big difference between what we're working on in our examples and actual financial markets is there's a lot more volatility when we're looking at actual financial markets. We still see that exponential growth over time, right? In both of these graphs, we do see exponential growth occurring, especially when we're looking at NASDAQ. But there's a lot more volatility, and there can be short-term significant loss in financial markets. All right, so what are the buyers and sellers composed of? There are retail investors, so people like us that are just buying and selling for ourselves. And then there are institutional or professional investors. So they're buying and selling securities on behalf of their employer, which is on behalf of investors. And there are many different types of professional investors engaging or actively engaged in financial markets. Very important thing to keep in mind with asset management is that net of fees, there's a substantive amount of evidence that on average, companies do not outperform average market performance, right? So net of fees, active financial management tends to lose money relative to just passively investing in a market. Right, that's why there's been so much, such a strong concerted push from financial professionals to individual investors to just passively invest, because it saves a lot of money, and saving just a couple percentage points per year can add up and compound to hundreds of thousands of dollars over the course of someone's career. And we can look at an example of that on the difference of with and without fees for fund performance. Right, and that can aggregate to a lot of money over the course of someone's life. We also have financial market information providers, right? So in order to make an investment decision, we need to understand a company's performance. So in order to understand a company's performance, we need information on that firm. All right, so who's going to be providing that information? When a company goes public, the firm itself is often going to be providing most of the information about the company, right? And that's actually one of the significant costs of going public, and part of the reason why a lot of companies end up going private, or not a lot of companies. It's one of the most common reasons for companies that go private after having been public is companies have to make financial reports, and that's extremely costly to the firm, right? There are teams of attorneys and accountants that are putting together the financial reports. If there's any material error in the report, the CFO and the CEO can be held responsible for that, and that could mean significant fines and or jail time. It also means that this company is providing information to potential competitors, right? When companies are posting their 10K, there's a lot of information about that company's performance that their competitors can use potentially against them. So public companies are required to make reports, and it's very common for companies to provide guidance as well, right? The only time in recent memory where companies haven't provided guidance was around COVID in early 2020. Basically, companies said, we don't know what's going to happen, so we're not going to provide any guidance. But typically, when a company issues their 10K, 10Q quarterly reports, executives are going to say, all right, we project that this is where we're going to have difficulty, this is where we're going to make significant value, and then talk about the reasons why. Then there's also financial analysts, right? So very often analysts will issue forecasts for whether a company is going to over, under, or meet expectations in the near future, right? So something like when you go on a brokerage account, a common feature nowadays is summary reports of financial analysts about a company's performance, whether they expect their share price to increase or decrease across time. So analysts can be a great source of information as well. When companies go public, very often they'll be covered extensively by news outlets, right? Whenever any material change in a company's performance occurs, very often news outlets will have some information about that. And an increasing source of information are just from other investors that are interested in companies, right? Some people will just be writing information on something like Seeking Alpha, Reddit, something like that, that they're trying to make an argument for or against the company's performance and just trying to offer their thoughts about it. Yes?
So when you were talking about how the firms they're required to make reports, those reports are audited by big accounting companies like Deloitte and EY and I don't know the other ones.
Oh, Edgar, that's what I was looking for. All right, so when a company goes public, you can freely find their filings. So Edgar, if you search Edgar, EDGAR, and SEC, that should get you here. On my home computer, I just have to type one, just it's automated or algorithmically suggested content. All right, so you could go in there, type the company's name or their ticker, or we were talking about Berkshire. Let's look at Berkshire. All right, so this will pull up information. You can also see, let's find their 10K. So the most recent 10K was filed in February from the previous year. All right, they have filings for public assets they have outstanding, right? They're Class A, Class B shares. Right, this is the standard information that's being posted here. And we'll just go ahead and skip down to financial statements, right? So they'll have information for the balance sheet, the income statement, cash flow statement, shareholder equity, management discussion and analysis, but there's a lot of information posted here, right? So we're looking at the balance sheet. So this is giving us companies' total assets and total liabilities. Let's see, where's our, their statement of earnings. So this company is a, I just forgot the word, conglomerate. It owns a lot of other companies that basically are autonomously functioning, but they also have, one of their main services are insurance. So they also have railroad utilities separated as well. And then they have a sub-aggregate of revenues down here, right? So this is a slightly unique way of presenting information. Very often revenue is going to be directly at the top, but because Berkshire is such a large conglomerate, basically they break up some different sources of revenue across many of their subsidiaries. All right, but we got total revenues, net earnings, loss down here, as well as our, where's our cash flow statement? There we go, consolidated statement of cash flows. And we can see any changes in cash at the bottom of this statement as well. Right, so freely available information. It's not aggregated in the easiest way. Very often there are other tools that people are going to have to use in order to get more concise and usable format. Nice thing with the SEC is go to the classic version and get interactive data. Excel document. All right, when companies report to the SEC, very often you can get an Excel file that already has their financial statement information. This can be beneficial. I do want to point out, though, that it's not uncommon to find errors in these Excel sheets that are translating the financial information. So that's just something to keep in mind. Right, so we can get access to these financial statements already posted. Where's our cash flow? There we go, statement of cash. All right, so where's our, there we go, net cash flow from operating activities. All right, so the material information you need is freely available, but again, keep in mind there can sometimes be errors in translation from the company's financial statement to Excel files. Actually, in the past when I've taught the financial statements course, some students found some of those errors and reported it to the companies, and they had to go back and correct that error. So just keep that in mind. There can be discrepancies from a company's filing to the Excel sheet you get directly from here. But again, there are paid services that a lot of people rely on that make up for those issues. They are very expensive, though. Bloomberg terminals are thousands of dollars a year to have access to. All right, so broadly speaking, the value of an asset depends on the expected discounted cash flows that asset is going to be generating. All right, so when we're looking at stocks, there's two basic ways that we can look at valuing these companies. We can look at free cash flow, which we are going to focus the last unit of this course on doing just that. And we also have dividends, which probably as far back as 50 years ago was the standard way of valuing public companies. All right, so a dividend is a payment from a company to shareholders. Usually it's in the form of cash, but it can be in the form of additional shares. But again, typically it's cash. And it just represents a return on capital to shareholders. It is paid at the discretion of the board of directors, right? So it's voted on a regular basis, but typically once a company starts paying dividends, they tend to continue paying dividends because markets react very negatively when a company starts cutting their dividends, which is unfortunate because it would be better for companies if they could freely use cash for investment opportunities, and dividends basically tie up a company's ability to take advantage of investments.
Are dividends required to pay like at least once a year, or like is that what the board of directors decide when to pay it?
So broadly speaking, there is not a legal requirement, but there's basically a market imposed requirement that once a company starts paying a dividend, they have to maintain the dividend. Otherwise, if they cut it, there's a huge drop in their share price. So
like if they don't pay dividend, the market will lower their value of the shares?
Only if they were previously paying dividends.
Oh.
Yes. So if a company has never paid dividends and they don't pay dividends, it's not an issue. But if a company has historically paid dividends and they cut that dividend or stop paying dividends, there's a significant drop in their share price. Yeah. That's part of the reason why there's been an increase in share buybacks over the last couple of decades is markets don't respond drastically to not paying or not instituting a share buyback. Whereas dividends, if companies cut a company's dividends, markets react negatively.
Why don't they make it legal to pay out dividends?
Why don't they what?
Why they don't make it legal, like the government? Why don't they implement like a law to make it like at least once a year for the board of directors to pay out dividends?
So it's not a topic that we're going to get into too much in this class, but basically paying dividends isn't necessarily good for shareholders. If companies have valuable investments to put their money into, that's what they should pursue over the long run. If they can get a return on investment that's greater than the average market return, companies should focus on that investment. Right? When paying dividends makes sense is typically if the company has excess cash that they're not using. Apple is probably the golden example for that. Apple is extremely profitable. They had a growing stockpile of cash that they weren't using, and shareholders were increasingly frustrated that they were doing nothing with this pile of cash. So they started mandating that the company start paying out dividends if it wasn't going to use the cash. But it's not necessarily beneficial if the company has a lot of investment opportunities to pursue. So if companies have investment opportunities, it's better that they use their capital for that rather than paying out to shareholders. So it's kind of situational and depends on the company. So mandating dividends isn't necessarily good for shareholders. Any other questions? All right, so usually dividends are a residual from profits, and they are very sticky over time, right? So like I'd already mentioned, investors react very strongly to unexpected changes in dividends. One good example of that is GE, right, which recently, or somewhat recently, cut the dividend that it's paying to shareholders because the company has been fairly unprofitable. It's working on breaking itself up into, I think, 3 separate components. Because it's a conglomerate that just became too sluggish for its own good, or too large for its own good, and it became sluggish. And when they cut their dividends, the share price dropped significantly on that announcement because that's often what markets interpret dividend cuts as, meaning is the company no longer expects to be able to use its profits to pay the company's dividends. All right, and this brings up share repurchases, like I had already mentioned, right? They've become a little bit more prominent. This is when a company buys back shares from shareholders. Very often on the open market, it can be on agreed upon repurchase. Basically what it does is it reduces the number of shares that are attributable, right? So it doesn't change the company's cash flow in any way. All it does is it reduces the number of shares outstanding that have a claim to the company's cash, right? So it's basically reducing the number of slices in a pie, so it increases the size of the remaining slices. So typically, similar to dividends, it's repurchases are going to be from profits, or if the company's just been accumulating cash over time. The important part and why companies have been looking at repurchases more than dividends is they're not sticky, right? Markets don't hold a company to a repurchase program like they do to a dividend program. So it gives a company a lot more flexibility to use its capital for what it wants rather than tying it up with sticky dividends. All right, so theoretically, the main point that companies should use for determining whether or not they're going to pay out dividends or engage in a repurchase is based on the return on investment that the company is earning. All right, so if So the basic structure optimally for a company paying out dividends is comparing the return on investment in the company relative to the average market return that investors can earn. So if the return on an investment within company is greater than the average market return investors can receive, the company should retain its profits and reinvest them in those high ROI investment opportunities. In other words, they shouldn't be paying out a dividend. On the flip side, if they have a return on investment that's lower than the market return, in other words, it's costlier to hold capital within the firm relative to paying it out and investing on the open market. In that situation, then a company should be paying out dividends. All right, so optimally, this is what companies would rely on whether or not they're going to be paying out a dividend in any given time period. But unfortunately, that's not what companies do in reality, right? So generally what they do is they get to a position where they're highly profitable, they start building up cash, like the Apple example, and then investors just want the dividends to be paid out. And once a company starts paying dividends, it's very difficult to walk that back and use the capital for other purposes. So hypothetically, this is what companies should use to make their decisions, but again, there's a difference between optimal and actual. And there's also the situation where a lot of investors want to receive dividends, right? So especially when people get toward retirement, they need a source of income, right, from their investments. So dividends can reflect or can be a part of cash flow for somebody because those dividends are just reoccurring payments from an investment. Also, just keep in mind that repurchases, right, these are easier to engage in because there is no expectation for maintaining any sort of repurchase program.
Is the market return, is that the amount that the market says that you should get back from your asset?
So technically what I'm referring to is the weighted average cost of capital, but that's a concept we're not going to get to for another month or so. So for now, you can just think of this as the average market return. So something between 8 to 12% on average. Yes?
I'm just curious, are dividends taxable or not?
Yes.
They are, okay.
Yes. So that's part of the argument why some people don't like dividends. Right, dividends are paid from profits, which are already post-tax. And then as the investor, you are taxed at a capital gains level usually if you're holding onto the stock. I don't remember the time period. I think it's at least for 1 year. And you receive a dividend, you can pay capital gains on that. I think if you hold it for less than a year, you pay ordinary income tax on it. I don't remember exactly the time. But yes, as the investor, you do pay taxes. If you're not on a tax-advantaged account, which reminds me. So, excuse me. There are two general forms of tax-advantaged accounts, right? Something like 401k or 401(b), which reduces your taxable income right now. And then the Roth IRA, which is net or post-tax income that you put into the Roth, and your investment gains in the Roth are not taxable on distribution. So if your investments are in Roth, you're not going to be taxed on your return on investment. All right, so I mentioned, right, we have free cash flow and dividends as a method of valuing a company stock. There's upsides and downsides to any way you choose to evaluate a company's performance. We're going to talk about a couple of the upsides and downsides. So for free cash flow, really this is the best measure of operating performance of a company. All right, so free cash flow is the best measure of operating performance. It captures true value. It captures the timing of any exchanging cash, which is really important because when a cash flow occurs matters to the value of that cash flow. Right? Again, time value affects the value of everything. The further in the future we receive our cash flow, the less it's going to be worth today. Cash flow makes adjustments to income that reflects its timing. It's also a metric that can be used for every firm. Right? And I say this because a downside to using dividends to value a firm is not all firms pay dividends. So nice thing with cash flow is we can apply this measure to every firm we're evaluating. On the downside, there's a lot of assumptions about cash flow, right? We haven't gotten into the very many ways that we can measure free cash flow, but there are a lot of ways we can measure it. And how we choose to measure it will affect the bottom line estimate of cash flow that we're measuring. It's also a lot more difficult and tedious than using dividends. Again, as we'll see when we start actually measuring free cash flow. Dividends are basically the exact opposite for the pros and cons. So unlike cash flows, it's very simple. We just look at a company's dividend paid out. Very easy to find that information. Dividends are also tend to be pretty sticky, meaning when a company pays dividends, they tend to increase slowly over time or stay at a constant rate. On the downside, these are really only applicable to dividend-paying firms. It's very difficult to value a company using dividends if they don't pay dividends at all. Maybe a little too simple. It ignores a lot of the operating performance of a company, right? companies lose money some years. Dividends don't reflect that. And companies have been increasingly unlikely to pay dividends, right? So at the early 20th century, most public companies paid dividends. That declined to, I think it bottomed out around a third of companies, and it's increased back to about, I think 40% of companies are paying dividends. But anyway, the majority of companies do not pay dividends. All right, so if we're going to use dividends to value a company, how exactly are we going to do that? Right, the basic way is we assume that the dividends are going to represent a perpetuity, and we use the perpetuity formula to make the valuation. So in other words, we'll just substitute stock-based information, so dividends, into the perpetual growth model or the terminal growth model. So we would use the next period's dividend divided by the growth-adjusted discount rate. And if the growth is equal to 0, then it's just the dividend divided by the discount rate. But again, this is just a time value formula that we've already seen.
You say use next month or next year's dividend. I can't remember.
Yeah, it depends on the situation, right? If the company pays dividends on an annual basis, yeah, you would use the next year's. So it just depends on the time frame that you're measuring the dividends over. Any other questions? Go over the example in Excel. All right. We'll go back to the examples next class. So often companies aren't going to pay a constant dividend, at least not at this point, right? So if this is going to be the case, then we're going to have to use dividend stages to represent the company's dividend growth, right? But really all that means is we're going to be using the discounted cash flow table, which we've already seen. We're just using it now for different stages of growth for a company's dividend. And there is, unfortunately, well, I shouldn't say unfortunately, there is a formula to capture this. But like I've mentioned in the past, this is one of those situations where I highly recommend not relying on the formula and using a cash flow table. Right? Formulas are always easier to mess up, especially when you're dealing with something with as many parentheses and fractions as we're dealing with here. So I definitely recommend using a cash flow table over the formula. But basically what we see here is we have the perpetuity value added on back here. So this is when the company's dividend is growing at a constant rate. So that's what the G2 reflects. We're growing at a constant rate in the second period. And this is getting the present value of dividends from the next period until it starts growing at a constant rate. Yeah, so I think we'll stop it at this part. Next class, we'll have a lot of examples to work through, and that's basically what we're going to focus on. So we'll be going over examples on calculating the return or the expected return for shares, as well as the value of share prices on dividends. So if there aren't any other questions, again, risk management and insurance is still going on. South side of the building, if you're interested in that, definitely recommend checking it out. Have a good weekend.